When uncertainty strikes, even the most stable financial institutions can find themselves in choppy waters. This is exactly what happened to some of Britain's largest banks this week, as whispers of a potential tax hike sent shockwaves through the market. But here's where it gets controversial. Should governments target banks with new levies just because they've benefited from favorable economic conditions? And could such moves inadvertently hurt the broader economy? Let's dive into the details and explore what's at stake. On Friday, European stock markets experienced a downturn as investor focus shifted toward inflation data from both the EU and the US, alongside growing fears that the UK government might impose additional taxes on commercial banks. By mid-morning in London, 10:23 a.m., the Pan-European Stock 600 index had dropped by 0.6%. Notably, every sector within the index was trading in negative territory. Leading the losses among major regional exchanges was France's CAC 40, which fell by 0.58%. France's consumer price inflation eased slightly in August, dropping to 0.8% from July's 0.9%, according to figures released by INSEE, the National Statistics Agency. This decline came as a surprise since experts polled by Reuters had anticipated another 0.9% reading. The softer inflation numbers were driven primarily by decreases in energy costs and prices for manufactured goods. Meanwhile, inflation rates for food and services stood at 1.6% and 2.1% respectively. Over in Spain, inflation remained steady at 2.7%. While Germany's latest figures were still pending release later that day. Despite these mixed signals, one area of the market showed resilience: defense stocks. Shares of German companies like Rheinmetall, Hensoldt, and Renk surged more than 3% each during early trading. This uptick followed comments made by German Chancellor Friedrich Merz, who expressed skepticism about the likelihood of peace talks between Russian President Vladimir Putin and Ukrainian leader Volodymyr Zelensky. However, British banking giants weren't so fortunate. Shares of Natwest plummeted by 4.4%, Lloyds sank by 4.5%, and Barclays slid by 3.5%. What's behind this steep decline? A report published by the Institute for Public Policy Research, IPPR, proposed introducing a special levy on commercial banks. The rationale? These institutions have reportedly reaped significant profits due to higher interest rates and bond buying programs initiated by the Bank of England. This proposal has caught the attention of UK Finance Minister Rachel Reeves, who is reportedly considering ways to shore up public finances ahead of her autumn budget announcement. While targeting banks may seem appealing politically, it raises critical questions. Could imposing new taxes on lenders discourage investment or tighten lending standards? Might businesses feel the pinch if banks pass along increased costs? Russ Mould, investment director at AJ Bell, weighed in on the situation, noting that traders are now questioning whether the days of outsized profits, hefty dividends, and aggressive share buybacks are coming to an end. He pointed out how ironic and potentially damaging it is that this debate coincides with a recent Lloyds survey showing rising business confidence despite ongoing cost pressures. If businesses interpret a bank tax as a sign of tighter credit conditions, the fragile optimism currently buoying markets could evaporate. Adding fuel to the fire, Mould also cautioned that Reeves must tread carefully. As she seeks to win over investors and maintain market confidence, any move perceived as unfriendly to shareholders could backfire. After all, attracting investment remains crucial for driving long-term economic growth. Meanwhile, across the Atlantic, Wall Street traders anxiously awaited the release of the Personal Consumption Expenditures Price Index, a key indicator monitored by the Federal Reserve. Last week, Fed Chair Jerome Powell hinted at the possibility of an interest rate cut in September, sparking widespread speculation. According to CME's FedWatch tool, there's roughly an 85% chance of a rate reduction next month. European markets haven't been immune to volatility recently, either. political drama in France, concerns over the independence of the Federal Reserve, and earnings reports from tech heavyweight Nvidia have all contributed to fluctuations throughout the week. Nevertheless, the Stoxx 600 index is poised to finish August with a gain of nearly 1.4%, marking its first consecutive monthly increase since January. So, what do you think? Is taxing banks a fair way to address fiscal challenges, or does it risk stifling economic recovery? Share your thoughts in the comments below. We'd love to hear your take.